So once again, welcome to Macroeconomics or Economics 1B, as you know it from your program handbooks. My name is James from Varsity Unlimited Tutors. I'm a private tutor who assists students with various subjects on the Mancosa platform. The way that we usually assist students is that we go through the tutoring where we are teaching you about the subject material from the first unit until the last unit, going through the study module. In addition to the lectures, we will have sessions where we go through your assignments, where we go through past exam papers, and where we also go through some KCQ questions, the past KCQ questions from the last years. This will help you prepare in terms of how you are going to answer and pass your KCQs, your knowledge questions, and also this will ensure that you pass your assignments. In addition, the preparation where we go through the past exam papers will also ensure that you get a very good mark for your Economics 1B exam when it comes in November and in December, and gain adequate knowledge in terms of Economics 1B, or as it is known, macroeconomics. So as we go through the lecture, you guys are free to ask specific questions that you might have. But in order to ensure that there is no confusion in the class, you can either type in your question, or you can try maybe raising up your hand using the computer, and then I can quickly see it, and then you can unmute yourself and say, so that we avoid a lot of people talking at the same time. But you guys are free to ask questions, to inquire about specific things, so that as we move together, no one is lost and we all get the correct knowledge. So what we are going to do is today, I'm just going to do an introduction to macroeconomics, which is your unit number 1. It doesn't have a lot of information. It's just some background information on macroeconomics and introduction to some key terms that you might need to know as you journey into macroeconomics. But going forward, as we go to the other lectures, we're going to go through unit number 2, unit number 3, unit number 4. So after each and every lecture that we have done, except for the one today, after each and every lecture that we've done, most of our lectures are 2 hours long. So after the lecture, which is 1 hour, 30 minutes, the last 30 minutes is usually dedicated to doing questions. So you guys have questions, you are free to ask them. And then in addition to the questions that you have, we actually go through past exam papers, we go through some KCQ questions that I've seen in the past, so that in addition to the knowledge that we discuss, you also get practice in terms of answering the questions that we are doing. So that's the normal approach that we usually do. But for today, it's just going to be 1 hour, very short, because we just want to introduce the subject and also briefly discuss the issue of payment terms for those that want to continue with the lessons that we will be hosting for microeconomics. So when you are studying microeconomics or Economics 1B, the first thing that you need to know is how is it different from microeconomics that you did last semester, Economic A? What is the difference between microeconomics and macroeconomics? So for those of you that were with me in the classes last semester, we already discussed some of these things. Now, the difference between the two is that when you're looking at microeconomics, that is Economics 1B, you're looking at the study of the individual choices that are made by specific economic agents, i.e. the people, and specific economic agents, i.e. the businesses that are within within an economy. Now remember, from our circular flow of income, we remember that they are economic agents, where we've got the households, where we've got the businesses, and where we also have the government and the international sector. Now, when we are looking at decisions that are made by the households and the decisions that are made by the businesses individually, this is what is called microeconomics. You're looking at specific choices, right? So from microeconomics, we discover the theories of of economics, because we discover the theory of demand, what makes people purchase a specific thing. We discover the theory of supply, what makes businesses sell a specific thing. We discover the theory of production, right? The theory of costs. How do businesses decide how much to produce, right? We discover about market structures and etc. All those different things. These are individual choices that are being made by specific individuals and specific businesses. But now when we're looking at economics 1B, which is your macroeconomics, you are now looking at things from an aggregated level. Aggregated, we mean we are summing up. We are taking the various individuals that we have and you are putting them together into a group. So instead of having the individual demand curve and the market demand curve, you're now talking about what we call aggregated demand. You are looking at the demand for all the people in South Africa. So instead of looking at a single business, you're looking at investment, right? At all the businesses that are in South Africa. You're looking at the government now. There's a lot of emphasis on the government decision-making processes when you're looking at macroeconomics. You're also going to delve into the international sector. So in microeconomics, you're looking at the individual level. At macroeconomic, you're looking at the aggregated level, i.e. the choices that are being made by all the people in the country, by all the businesses in the country, by the government within that specific country. So those are the differences between the two. Okay. So now when you are studying macroeconomics, there is a context of how you study macroeconomics. Most of the topics that you're going to study macroeconomics fall within this context. This context, some authors say that these are called the economic indicators. Some say these are called the macroeconomic objectives. But for your lecturer, let's use the word macroeconomic objectives. Now you might ask, what are these macroeconomic objectives? The macroeconomic objectives, we are basically saying that a government, when it is making decisions about its country, when it is making decisions about what to produce, how to produce, and for whom to produce, they are going to look at 5 specific issues. The first issue that they're going to look at is economic growth. The second issue that they're going to look at is the employment level in the country. The third issue that they're going to look at is price stability. The fourth issue is the balance of payment, or the international part. And then the last issue is the equitable distribution of income within that specific economy. So those are the 5 macroeconomic objectives. Now, I'm going to give you a bit of a background on these macroeconomic objectives, because like I said, all the other topics, like if you go to Unit 2, Unit 3, Unit 4, Unit 5, Unit 6, all of them come back to the macroeconomic objectives. You're now just basically going deeper and discovering more about a specific macroeconomic objective. So for example, the macroeconomic objective of economic growth. What is it? What does it mean? Why is it important? Now, when you are looking at economic growth, you're looking at an economy such as South Africa, and you're asking yourself, how much output is being produced by South Africa? How much gold, how many cars, how much wheat is being produced by the country? How much products and services are being produced by the country of South Africa? So that is the output. So if the output being produced by South Africa grows over time, we call that economic growth. But if the output of South Africa shrinks over time, then there is no economic growth in South Africa. Now, as you go deeper now in the study of economic growth, you're going to say, how do we measure economic growth? Then you're going to start to look at issues like the GDP per capita, like the issues of the GNI, the issues of the GNP, all of those different things. We will talk about them when we get to the specific topic a bit deeper. But basically, you're looking at what we call the gross domestic product, the gross national product, the gross national income of that specific country. And then when you calculate this gross national product, in essence, when I'm saying gross national product, is we are just adding things. We are saying the cars that have been produced plus the cell phones that have been produced, plus the wheat that has been produced. Of course, we are taking values like dollar values or rand values. We're adding all of these things and we're coming up with one figure that is going to be our gross domestic product. And then if we divide this GDP by the population of the country, we get what we call a per capita GDP, which represents the wealth that is attributed to each individual South African within a what? Within a country. Now, don't worry if you don't get much of what I'm trying to say right now. Like I said, there are topics where we are going to get deeper and explain further into some of these various terms. I've just given you a bit of a background of what we are going to be talking about. So that is what? That is economic growth. Then we are also going to tie in the concept of economic growth to the concept of the production possibility curve or the production possibility frontier that we discussed in Economics 1B. And we're going to highlight when the production possibility curve shifts to the right, what does that mean in terms of economic growth? When it shifts to the left, what does that mean in terms of economic growth for a specific country? So we are going to take in some of those theories that we've already discussed, and we are going to what? To align them to the concept of economic growth. So that is the first macroeconomic objective. So I'm sure by now you're already thinking, so if this is an objective for the government, the objective means that they want to increase the economic growth of South Africa over time. So that's objective number one. Then if you go to objective number two, you are looking at what we call full employment. Now, remember from our study of microeconomics in Economics 1A, we talked about the 4 factors of production, where we said there was land, there was labor, there was entrepreneurial skills, and there was capital. Right? Those were the 4 factors of production that we said are being used in an economy. Now, you might ask yourself, are these factors of production, are they being fully employed by the what? By the nation or not? For example, if there are 25 million South Africans who are at the edge where they should be going to work, are they all going to work, or some of them don't have jobs? That is what? That is unemployment. So this is what we are discussing under full employment. We're discussing the utilization of the resources that exist within South Africa. And one of the topics that we are going to discuss a lot about is going to be unemployment. We're going to define what is unemployment. We are going to define what is unemployment, what are the different types of unemployment, what are the causes of unemployment, how can we solve unemployment within the what? Within the specific economy. So that's under what? That's under full employment. Then the third objective, we said price stability. So when we're looking at price stability, we're basically asking ourselves, what is the general price level of goods and services being provided in South Africa? Are the prices in South Africa increasing over time, or are they decreasing over time, or are they staying at the same place? So some of you already know we're talking about inflation, right? So that's basically what we'll be talking about. How do we measure inflation? What are the causes of inflation? What are the effects of inflation? How do we solve inflation? How do we remove inflation or reduce inflation from the economy? So we'll also, under this topic, discuss a little bit about money creation, about the role of the South African Reserve Bank, and also about the monetary policy of a specific nation, right? About the repo rates, the interest rates, about the banking system, and etc. We just discussed briefly also about those issues under this specific topic, which is your price stability. And then after price stability, we'll talk about the balance of payment stability. This is your international sector. We are basically saying that from our secular flow of income, remember, we are saying that the country of South Africa operates and trades with external partners. They're going to trade with Russia. They're going to trade with the USA. They're going to trade with Botswana. So in their trade, they're going to be using the rand. They're also going to be using the pula. They're also going to be using the yuan and the dollar. So how is the rand going to be exchanged? What is going to be the exchange rate? What determines this exchange rate? And then after the exchange rate has been determined, what if we don't have enough British pounds to buy things from South Africa? How do we solve that as a country? What if we end up with a balance of payments deficit? What if we end up with a balance of payments surplus as a country? How do we solve that? What is the effect of that on us as individual South Africans within the what? Within the country. So those are some of the things that we'll be discussing under the balance of payment stability. So this is our exports and our imports. And then lastly, we will also discuss about the equitable distribution of income. On this topic, the first topic, I think it will actually be economic development, where we are saying that we are going now to ask ourselves, does economic growth equate to economic development? What do I mean by that? I'm saying that if output is increasing, right, over time in a country, does that mean that every South African is also getting wealthier? Does that mean that delivery of goods and services is improving in both the public and the private sector? If not, why can there be differences? So what other measures can we use to try to assist and see the level of economic development in the country? This is where now we understand where they are saying that these countries are the developed nations, these countries are the developing nations, these countries are the poor nations that are undeveloped, where we understand where those definitions are coming from and the things that are looked at when we are coming up at those definitions. And then we're also looking at the wealth inequality between individuals in a specific country and what effect does it have on the what? On the living being of individuals, and also on issues of politics and social conflict that might exist within a specific country. So those are some of the things that we're going to look at. And of course, how can we solve that particular issue? Now, in combination of all these different topics, we are going to ask ourselves, which objectives should a government choose? And what tools are available for the government, right, to pursue the specific macroeconomic objectives? You're now looking at your monetary policy and your fiscal policy as implemented by your government. So we're now also going to understand the issues of the State of the Nation address, what that implies, or the budgets, the monetary, the medium-term monetary budgets that are done by the government, and what are the impacts of those budgets on the economy. We're also going to look at issues of taxation and etc., and the impact on the what? On the economy. We're also going to look at the business cycle and its impact on the economy. So all of those things, they are all part of these 5 macroeconomic objectives that a government might want to pursue. So this is basically what macroeconomics is all about. In short, or in summary, this is what we're actually going to be talking about for the rest of the semester. We're just going to go deeper into each and every one of the specific topics. Now, in addition to this, in terms of our introduction, we also just want to go back a little bit to our microeconomics and highlight on the circular flow of income, because it also plays an important role when you are discussing your macroeconomics. It is one of the foundational principles of macroeconomics in understanding of the circular flow of income. So we are also going to briefly just look at it and its concepts before we get into the rest of the what and the rest of the stuff. So remember, from our microeconomics, I hope you guys covered it. If you didn't, then good luck. We're going to cover it today. Okay. So in terms of the circular flow of income, remember we said that there are 3 major flows within an economy, right? There are 3 major flows within an economy. There is the flow of resources, right, that are flowing from the households to the firms. Now remember what we said resources are. We said resources are labor, resources are land, resources are capital, resources are entrepreneurial skills. Now, and remember, when we're talking about land, we're talking about a lot of different things there. So those are the resources. So these resources are owned, right, by their households. They are the owners of the resources, and they sell the resources to the what? To the firms. So there is a flow of resources from the households to the what? To the firms or to the businesses. That is our first major flow. Then the second major flow is we are saying that the businesses themselves take those resources and then produce goods and services, and then the goods and services produced by the businesses go to the households. So that is your what? That is your second major flow, the flow of goods and services from the firms or the businesses to the households. Now, the third flow is now the what? The financial flows, i.e. the flow of income and the flow of spending, which go in the opposite direction of the first two major flows, right? So the third flow is the financial flows. Well, we're saying that in the financial flows, the companies are going to pay the households. What are they going to pay? They're going to pay rentals. They're going to pay interest on capital. They're going to pay profit on skills. And they're going to pay wages on what? On labor, right? So that's one side. And then on the other side, we're saying that the households are going to spend that income on the goods and services. So those are your financial flows. So three flows: production flows, resources flows, and financial flows. So those are our three major flows in an economy. It's important to understand some of these concepts because as you delve deeper into macroeconomics, you're going to see the impact of various decisions made by the government on each of the different flows. Then using the specific three major flows, we then came up with what? With the secular flow of what? Of income in an economy. Where we say that if an economy is closed and only has businesses and households, right? If it only has businesses and households, we highlighted that we are basically going to look at our resource market, we're basically going to look at our product market. And where we are saying the flow of resources, right, which is our first major flow, households to what? To businesses through the resource market. And then our second major flow, which we said is goods and services, is business to households through the what? Through the product market, right? And then we said our third flow, which is the financial flows, which move in the opposite direction, where we are saying now the businesses pay the households the wages, rents, interest, and profits, and then the households spend that on the what? On the various goods and services being produced by the what? By the businesses. So that is our generic secular flow of income for a closed economy. Closed economy, we are saying that there is no international sector, and also we are saying that there is no government that we are talking about here. And then when we open up this economy, right, and we say that now there is a government that we want to talk about, right? The government introduces it introduces the public goods and services, your roads, your police, right? The public sector, all the goods and services that they're going to do. So they provide these goods and services to their households, and they also provide these goods and services to the firms. Right? The government also introduced taxes, which is the financial flow. When we're saying that the firms are going to be paying taxes, and their households are also going to be what? To be paying taxes. Then the government also interacts with the factor market and with the goods market. Right? In the factor market, they are going to what? They are going to go and get labor that they need. But in the goods market, they are going to what? They're also going to go and purchase various goods and services that they might also need to use. Their bond paper, their computers, and etc. that they need to use in the what? In the public sector. And then we can even go a step further here when we go to the last part of our module. We can even also introduce what? The international sector and how it interacts with these two. Well, we're saying that the households are going to export so are going to import from the international sector in terms of goods and services, and they're going to export their labor to the international sector, whereas the firms are going to export their goods and services to the international sector, but they're going to import the resources from the what? From the international sector. So again, there is an extra node that you can also introduce in terms of the what? In terms of your secular flow of income. So this basically closes up our introductory to economics 1B, which is your what? Which is your unit number 1. This is where unit number 1 what? This is where unit number 1 ends. So like I said, what we usually do is we try to get a couple of questions and we go through the questions so that you can also have a bit of an overview of what we just studied. So for unit number 1, there isn't really many questions that you can talk about. You can actually maybe discuss a bit of questions on the on the secular flow of income. You can discuss those, but I'm sure those of you have already done them under economics 1A. So just don't want to repeat what you have already done. But if we do face some questions when you do pass the exam papers, if we do get questions, we will of course go through them. So guys, this is the end of what? Of unit number 1. Then you now go into what? Into unit number 2, where you're now talking about the macroeconomic, where you're now talking about measuring the performance of the economy, or in other textbooks, it is known as national income accounting. So national income accounting, or measuring the performance of an economy, you're basically going back, remember, to what? To unit number, to our objectives. You're going back to the first objective, which was economic growth. So if there are any questions before I start on this one, you are free to ask them at this specific stage in time. If there are any questions, you are free to ask them before I continue, because we still have time. We still have around 30 minutes before we finish. So if there are questions, you are free to ask. Okay. Okay, I trust you're all happy, so I'll just continue. So topic number 2, national income accounting, or measuring the performance of the economy. Now, when you're looking at South Africa, right, there are various statistics that you always see on the news or on the internet, right? These statistics are usually provided by the South African Reserve Bank. They are provided by the Treasury Department, the National Treasury of South Africa, or the Ministry of Finance, as you know it, and they're also provided by an organization called Statistics South Africa. So you notice that they provide a lot of statistics on the economy. So these are some of the statistics that we also want to discuss. So one of the major statistics that they provide is gross domestic product and gross national product, or in summary, what is called national income. For what? For South Africa. Now, when you're looking at gross domestic product, the technical definition, right, states that it is the market value of all final goods and services produced in a country in a given period. Now, what does that mean? Because we just don't want to read the definition. We want to understand what does that mean. When we say goods and services, right, we are saying that in South Africa, we produce gold, we produce platinum, we produce cars. There are companies that produce computers. There are companies that produce clothes. There are companies that produce wheat. There are companies that produce tractors. There are companies that produce bread. All of those are goods and services, and all of those are included in the what? In the measurement of gross domestic product, right? All of those, right? And then when we say market value, We are saying that bread is the market value. If you go into Spar right now and you want to buy Albany bread, it's going for 13 Rand 50, right? That is the market value of bread. The final price that you pay for the bread, that is the market value of bread. Now, as we go deeper into this, you actually notice something. Because remember, bread is a combination of different things. In a loaf of bread, you are going to get wheat in a loaf of bread. In a loaf of bread, you're going to get flour in a loaf of bread. In a loaf of bread, there is the plastic covering. So there is the farmer, there is the granary, there is the bakery, and there is the packaging company. All of those companies produce something. So when we are measuring GDP, you might ask your question now this. Do we measure all the wheat produced by the farmers, and then we measure all the flour produced by the granaries, and then we measure all the plastics produced by the packaging companies, and then we measure all the bread produced by Spar? Doesn't make sense, right? Why? Because you're duplicating. Because the loaf of bread already includes the efforts of all these different things. So because of that, that is why we say, number one, GDP is the market value, which means the market value, the final price of all the final. That is why I underlined final. Final, you're looking at the last product in a supply chain. You're not worried about the things that are underneath. You're looking at the final. What is the final product? You don't want to include wheat. You want to include the final product of wheat. Right? You don't want to include iron. You want to include the final product of iron, of goods and services produced in a country. Now, I underlined produced in a country. That is very important, because when you're going to look at other definitions, you are going to see that it is no longer about in a country. So when you're looking at GDP, market value, final goods and services produced within South Africa, i.e. produced in South Africa over a period, usually a year. So that is the definition of what? Of GDP. Now, there are different ways of measuring GDP. We are going to talk about it. We are going to talk about it a bit later. But before we do that now, so if we have measured GDP this year and we measure GDP next year, so if GDP this year is 100 billion South African rand, and GDP next year is 150 billion South African rand, which means that it has increased by 50 billion South African rand. And that is what is known as economic growth. Okay. So that's GDP, right? Now, there is something that is different. There's something that we call gross national product. Now, GDP, when it said gross domestic product, domestic means produced within a country. That's why we underline produced within a country. But when we say gross national product, we now remove the produced within a country. So gross national product, this is the production resulting from the employment of the permanent residents of South Africa, wherever they might be. So if you are a South African and you have produced something, whether you are in South Africa or you are in Botswana, in the USA, or in Russia, when we are measuring GNP, we include you, right? But when we're measuring GDP, as long as you are not in the country, we don't include you. We include everything in the country. Even if you're not South African, even if you're Mozambican and you are in South Africa, if you produce something, we include it under GDP. But under GNP, we only want to know the things that have been produced by South African nationals. So that's an important definition. It's always examined in your exam papers. So if someone asks you what is the difference between the two, you're saying that GDP produced within the borders of South Africa, GNP produced by South Africans, regardless of where they are. Okay, I think that's very clear. Now, there are three methods that you can use to calculate your what? Your GDP, right? There is the production method of calculating GDP, there is the expenditure method of calculating GDP, and then there is the income method of calculating GDP. So those are our three methods of what? Of calculating GDP. Now you might ask, what are these methods? What are you trying to talk about? Production, expenditure, and and income method. What are you talking about? So for you to be able to use this method, you need to have a specific understanding. Now, under the production method, for example, this is what we are going to do if we are going to what? To produce the what? Under the production method. So let's assume, for example, that in South Africa, we only produce bread. That is the only product that is produced in what? In South Africa. That's an assumption that I'm making right now. That is the only product that is produced in what? In South Africa. We are only producing bread. So if you're asked to use the production method to calculate the GDP of South Africa, how are you going to do it? So you're basically going to say, how much wheat is the farmer produced, right? So the farmer has produced 5 tons of wheat and whatever the price of wheat, and then you're going to say, ara 100 million in wheat, right? That is the value of the wheat. Now, you go to the next stage of production because it's not only wheat. After they've produced the wheat, they are going to send it to the millers, and the millers are going to grind the wheat and produce flour. Now, when you value the flour, right, of the miller is going to tell you, my flour is valued at 110 million rand, right? But this is incorrect now when you're using the production method. Why? Because we are saying that the miller had to buy the wheat from the farmer, right? They had to buy the wheat from the what? From the farmer over here. And they had to pay 100 million from the farmer, which means that the miller over here only added 10 million rand only, because 100 million was already produced by the farmer, which they had to pay. So if it is now 110 million, they only added what? They only added 10 million. So 10 million is the value of the miller. And then you go to the next stage, you're going to go to the bakery, and the bakery is going to tell you, what? The bread that I've produced from the flour that I go to the miller is worth 100 and what? 120 million. Again, this is what? This is incorrect. Why? Because the bakery had to buy flour from the miller, and they paid 110 million for them to buy that what? That flour. So the bakery only added 20 million rand. So that is the value that they what? That they added. And then you go to the last stage. You go to Spar, and Spar is selling their what? Their bread. And in total, the amount of sales that they've sold, they will tell you, we sold bread for 130 million rand. That is the total value of the bread that they sold in a year. Again, you cannot value it like that. That is wrong. Why? Because Spar had to buy the what? The bread from the bakery and pay 120 million. So they only added another what? Another 10 million. So when you are using the production method, you are going to add the value added by each economic agent at each and every stage, which means that GDP in South Africa is going to be equal to the value of the farmer plus the value of the miller plus the value of the bakery plus the value at what? At Spar, which is equals to GDP is equals to the value of the farmer, which is 100 million, plus the value of the miller, the added value only, which is 10, plus the value of the bakery, which is 20, plus the value of Spar, which is 10, which is going to be equal to 130 million. Now, I'm sure most of you already see a trend over here, which we talked about earlier, where I said that the value of the final goods and services. What was the final good? The final good was bread at Spar over here. This was the what? This was the final good. And what was the value? It was 130, which is what we eventually got in terms of our GDP. So that is how you calculate your GDP using your what? Your production method. So essentially, you are just adding the value addition at each and every stage. Now, the second method, which is the easiest method to use when you're doing your what? Your expenditure method, right? Is when calculating GDP, is your expenditure method. How much has been spent by the people in that specific country. So again, if we go back to our example, how much has been spent on bread? You just go to Spar. How much did people spend on bread? 130 million. And then you get your what? Your answer. So when you're using the expenditure method, you're going to look at the expenditure that has been done in the economy. However, you have to note who is spending in that economy. So the expenditure formula, you are going to add the expenditure by the household. That is the expenditure by you and me. You are also going to add the expenditure by the businesses. That is what we call investment expenditure. And they're going to add the expenditure by the government. That is what we call government expenditure. And lastly, they're going to add the expenditure on exports versus the expenditure on imports. That is exports minus the imports that have been what? That have been done. And from then, you can now get your what? Your GDP from the expenditure method. So it's household expenditure plus business or investment expenditure plus government expenditure plus exports minus the imports. So that is the expenditure method of calculating the what? Your GDP. Then lastly, the other method that you can use to calculate your GDP is what you call the income method of calculating the GDP. Now, when you're looking at the income method, you're looking at the factors of production. Remember, we said that there's what? There is land, there is labor, there is entrepreneurship, and there is what? And there is capital. So for your land, right, everyone who owns land in South Africa, they're going to get rentals, right? Everyone who owns labor in South Africa, they're going to get wages, right? Everyone who owns capital in South Africa, they're going to have interest, right? And everyone who owns entrepreneurial skills, right? Who have an entrepreneurial mindset, they're going to get what? They're going to get profit. So if you add these four things up, you're going to get your what? Your GDP from the what? From the income side of things. So if you calculate GDP using production method, using expenditure method, and using income method, you should get the same figure. They should not be different. They should be the same figure. If there is a difference, there are some nitty-gritties that you need to do. I don't think for your module it's that important, but we'll talk about them in our next lecture. But there are some nitty-gritties that you can do if you do get different figures. But essentially, that is how you determine or how you calculate your GDP from those specific methods. Your production method, your income method, and your expenditure method. And you can see from this diagram that we can tie that back in to our circular flow of what? Of income. Remember, we said that there are three major flows in an economy. We said that the production flow, the goods and what? And services. We said that the resource flow, right, of resources. And lastly, we said the spending flow, right? Those were the three major flows. So the three methods of measuring GDP basically measure those three flows in an economy. The production flow is measured through the production method of measuring GDP. The income flow or the resource flow is measured using the income method. And then the spending flow is measured using the expenditure method. So that's basically the concepts that I just wanted to highlight to you guys before we end our lecture today. So that's an introduction to macroeconomics. Now, in our next lecture, what we are now going to do is we are now going to talk about some of the other nitty-gritties that are surrounding issues of GDP. For example, we'll discuss issues of real GDP versus nominal GDP, i.e. the effects of inflation in measuring GDP. We'll also talk about the price index, though this is not really that important for you guys, but we'll also just highlight it so that you just are aware of some of these funny things. Then also we'll talk about GDP at factor prices and GDP at market prices, i.e. the small differences that you can get when using the different methods of calculating GDP. And then we'll also talk about the problems associated with what? With using GDP as a measure to assess wealth within a what? Within a specific nation. And then lastly, we're going to give you some alternatives in terms of what? In terms of calculating GDP. And then I'm going to introduce briefly the concept of national income, because we are going to need that when we do the theories, the Keynesian theories and etc. We're going to need a basic understanding of what national income is all about. So in the next lecture, we're going to cover that. And then after we are done, then we're going to go through a past exam paper, and we're also going to go through some short questions in terms of just try to gauge if you guys have understood what we've talked about. But for today, I am done with the lecture. I don't know if there are any questions that you guys might have, but while you guys are thinking of the questions, I'm going to highlight this. Now, for us to proceed, right, as we usually do, there is a payment that you have to make for you to continually join within our classes. The payment is 650 Rand. It is for the whole semester, right? It covers the lectures that we do. It covers the videos that we are going to provide you guys with. It covers a guidance in terms of your assignments. We will guide you in terms of what you need to do so that you get your distinction in terms of your assignments. And it also covers the past exam papers that we're going to do in preparation for the what? For the end of semester exams. I'm going to post in the group my banking details and the day of the next lecture. So if you're interested in joining us, please make the payment, send me the proof of payment, and then I'll add you to the what? To the classes as we continue. But if you're not interested in the classes and you still want assistance from us, you can stay in the group. Don't leave the group. You can stay in there. You can always ask in the group, and we'll see how we can assist each other. If you want one-on-one assistance, just struggling with a specific question on the assignment and etc., please contact me. My WhatsApp is always open. You can call me. You can send me a WhatsApp, and I can see how I can further assist you as a student. But for the general classes, as I highlighted, it's 650 for the whole semester. For economics 1B lessons. The payment terms are available. If in case maybe you're saying 650, I can't do it at once. I just want to pay maybe part of it. Payment terms are available. Any questions, guys, before I end this specific lecture? Any questions before I end the lecture? Okay, I trust you're all happy. I trust you all have a pleasant evening. See you in our next lecture. Thank you.
Thank you. Bye.
Bye-bye.